Is DeFi dead? Is ETH dead?
ETH is still going to be here, no question asked. Right now, DeFi is extremely fragmented. You need such trade in place to converge rates, essentially, and to keep the market efficient. We're on track to hit like 1 billion in trading volumes on the benchmark that we have.
Why can't I use a traditional finance benchmark rate?
I think it's better to use a decentralized framework to build a benchmark rate.
What does this unlock for the crypto space?
I think the next stage is we're on Twitter, everyone's saying like retail, there's a lot of fatigue, but from the institutional side, they're more excited than ever.
What's your broadest goal with this project?
We want to be
Awesome. Looking forward to this conversation today with Brandon from Treehouse. We're in studio in New York, which is always a pleasure, and me and Brandon have known each other for a couple of years now. Yep. If you're a frequent listener of this podcast, you know I like to start off with a hot take. So you're building a protocol highly related with DeFi, highly related with ETH. Is DeFi dead? Is ETH dead?
That's a great question. I think when I look at, let's take a step back and look at the state of crypto in general, right? The market's around like 2.5 trillion, right? A big chunk of it, 80% of it is BTC. The remainder, majority of it is still ETH. So despite the price action over the past few weeks, few days, I don't know when this podcast is going to go out. I think, ETH is still going to be here, of course, right? No question asked.
Right. Well, something I like to think about too is like this idea of value creation over time, right? And if you guys are building for a multi-year timeline, which I know you are, or multi-decade timeline, we imagine, again, eliminating Bitcoin, the digital asset industry goes from $1 trillion to $10 trillion. Within that, there's $9 trillion of value to be captured, right? So it's like the opportunity is still immense, despite a certain corner of the market being a little, behind or in a kind of bearish condition. So
yeah, no, I completely agree there.
Excellent. Well, I'd love for you to introduce yourself. Who are you and what do you do?
Yeah, sure. So I'm Brandon. I'm the co-founder and CEO of Treehouse. Background-wise, before this, I was at Morgan Stanley. I was doing credit derivatives, so very much from the traditional finance world. And prior to that, I was doing mortgage-backed securities. So fixed income through and through since I graduated from university.
Excellent. And you've been a Web3 founder for a few years now. Do you feel like that background has helped you out?
For sure. I mean, I think, what we're trying to see, for at least my view of DeFi, is that eventually, whether it's TradFi or DeFi, it's just going to be finance. And you can bring a lot of the same things that we do in traditional finance and bring it into DeFi. And that's exactly what we're doing.
You mentioned, in previous conversations we've had, you've mentioned this kind of moment where you kind of got red pilled by DeFi, right?
Yep.
And I think a lot of people have had that moment. Talk about what that looked like for you.
Sure. I was still at MS. Well, I mean, I was already holding a bit of crypto, but I wasn't at MS and the DeFi summer was starting to brew.
Right.
We had a group of friends that was on the trading floor that were very, very active. In the day, we will be actively, doing our own work. And then by the time it hits nighttime, we'll all be degenerates. We'll be looking for the next biggest play.
Right.
Obviously, what really struck me was when I first saw the AMM model, when Uniswap came out, because we were sitting on a market making desk. And to be able to abstract that away through smart contracts blew my mind. And very quickly, we had a few guys that left to start bigger firms. Like Amber, it was the guys that were sitting in the same desk as I was at. A few friends started hedge funds, and I was like, it's time for me to go. It's time for me to go to jump over to the other side.
Yeah, that's very interesting. Like, for some reason, it seems like finance-oriented minds are particularly like susceptible to being one-shotted by DeFi. Yeah. Like I studied finance as well, and I wasn't ever at a bank or anything, but it's the same thing. When I saw DeFi, I was like, oh my God, seeing the finance analogs on digital rails it's easy to see that like there is something here, right? There's something substantive.
Oh, for sure. I mean, yeah, it's just so much more efficient. The AMM model just blew my mind away.
And then at that time, DeFi was incredibly early, so there were a lot of like difficulties with the space. Whether we were using MetaMask, Ethereum, paying $100 for a transaction, $150 for a transaction. What were some of like the early obstacles that you saw participating in early DeFi?
Yeah, I mean, it was just so much fragmentation, right? So much information asymmetry. Felt like the Wild West, but which was fun too in itself, right?
Right.
The space has matured so much since, right? The cycle before versus now has changed drastically, and I think we're starting to mature in general, which is great. I mean, if we want this space to be serious, ultimately we need to mature. We need to bring in new asset classes, new products that TradFi can look at and say, okay, that's a serious asset class. It's a serious topic that they can get involved in, rather than it's just a playground or a casino.
I think another interesting component of those like first gen DeFi projects is like a lot of those early winners didn't end up being winners, right?
Yeah.
Like Compound is, being like governance attacked, right?
Yeah.
Sushi doesn't, I don't even, it maybe exists, but it's not relevant, right? On an industry level scale. So has been a real opportunity for people who have improved on kind of the primitives that we started to kind of coalesce around in those early days of DeFi.
Yeah, no, I completely agree.
Right.
Yeah.
So talk to me a little bit about like Treehouse, right? If you were to explain to the average, consumer or user of Coinbase or something, explain it from the highest possible level.
Sure. So Treehouse, we call ourselves the decentralized fixed income layer. The premise of it is simple in that, in traditional finance, fixed income as an asset class is 5 times larger than equities. It's way bigger than commodities. But when you talk about fixed income in crypto, it's almost non-existent. We believe that's particularly due to missing infrastructure, and particularly benchmark rates. So that's what we're trying to solve. So Treehouse, we have 2 main products. One is called T-Asset, and the other is DOR, which stands for Decentralized Offered Rates. I'll take a pause there. I'm sure we're going to go into the details.
Okay. So explain both of those concepts to someone who's not as financially native.
Sure. So maybe before we jump into both products, I think to explain what fixed income is,
Sure.
Right? Fixed income is the asset class that, where institutions play most in, but from a retail level, we all touch it in some form of way. Whether you have like a mortgage, you have like a bank savings account, you earn a yield on that. Anything that has a some form of yield that is like a fixed stream or even a variable stream fits into that umbrella.
Right.
So it's a massive asset class. The problem, however, in crypto is that everyone's like here for a Lambo, right? Everyone's like, when Lambo,
Right.
And having the notion of a fixed stream of yield, it doesn't sound as exciting, but you do need the Toyotas in this world, and that's what institutions going to look at when they come in, right? Something safe, something predictable, and that's what we're trying to achieve here. To jump into the 2 different products that we have. T-Asset is quite straightforward. It's a liquid staking token, with a twist. And the twist is that we have an embedded arbitrage strategy on top of it. And that strategy helps do a few things. So the first of which is it's democratized access to this particular trait. Now you can earn not only just like STE field, which we use as the underlying, but you can earn additional pickup of like 30 to 80 bips that is technically arbitrage, right? And the second feature of T-Asset is that by doing this strategy, we're helping keep the market efficient. I talked about fragmentation earlier. Like if you get on Compound, you get on Aave today, all the biggest born lending protocols, the rates are all over the place, right? It's fragmented. You're not going to see that in traditional finance. Like when you go and borrow money, you're not going to be able to borrow it below where the government borrows it at,
Right.
unless it's your dad, right? Unless it's like your family member. So that strategy helps keep the market efficient. And right now, DeFi is extremely fragmented. We need such trade in place to help keep it converge rates essentially,
Right.
and to keep the market efficient. And then the final thing about T-Asset is that it powers the second component, which is DOR, Decentralized Offered Rates. I'll take a pause here first.
So why do you think the market is so efficient in this rates, and why is it important that the market becomes more efficient in this?
So the market's inefficient right now,
Sorry,
right?
yeah.
The other way. So it's extremely inefficient just through, the space is still relatively small. Like, you see $1-2 billion like TVL market size. That's the equivalent of like one corporate bond, in the traditional finance world, right? And the type of players that are on here, they're not necessarily, understand the products that they do. And there's no standard around it. That's even more important. Like if you look at the fixed income market, when you trade bonds in a bank, we look at like ratings, like credit ratings. So Moody's, S&P, and Fitch would provide such ratings for every bond that is, the most active bonds. They would have a rating. Those ratings are, they're mostly wrong actually, and it's always retrospective in the way like how it reacts. Like the company will go bankrupt, then Moody's will go in there and be like, oh, now it's an F, right? Yeah, it's a bit late by then, but that standard helps a lot, right? And there's also benchmarks, to make it clear that this is like the minimum yield hurdle you should be receiving.
For kind of a given level of risk, right?
Yeah, or at least like the risk-free rate in that space in general. In DeFi, you don't have any of that, right? There's kind of things that are thrown at you, and from all different fronts. There's like, oh, it's different layer ones, different layer twos, there's bridge risk. There's like stablecoin risk. There's so many different elements that kind of confuse players, I think. And that's also great because there's opportunities for people to make a lot of money, which you can in crypto. But we're trying to bring standards. We're trying to mature the space. And yeah, I mean that's our main goal.
And then this kind of ties into your second product, which do you want to explain?
Yeah, sure. So decentralized offered rate. In short, it's a benchmark rate that is decentralized. Maybe I'll kind of explain it from a traditional finance perspective. I think that's helpful to really understanding why do we even need one in DeFi or just in crypto in general. So let's go back to the 1980s. Right, in the 1980s, the fixed income market wasn't as big as it is today. I mentioned earlier that it was 5 times larger than equities.
Right.
If you go back then, the size was probably on par with like equities. You could get like a mortgage then. You can get like just a loan from a bank. But when you look at a term sheet, so you always get a term sheet for any kind of instrument that you do, whether it's like a mortgage, there will be a reference rate on it. And at that point in time, depending on where you got the loan from, if you go to Citibank, it'll be like the Citibank reference rate. If you go to BAML, it'll be the Bank of America reference rate. And there was a lot of fragmentation, kind of like what crypto is like today. So it reminds me of the older days in the fixed income world.
And how different did they tend to be?
It's just completely different methodologies that were used. So like the way to calculate it, different baskets. And that confused a lot of people. And from a bank perspective, warehousing that risk, it was hard for them to then hedge it out. Right, because if I go to a different bank to like, hey, I don't want this risk anymore. Can I pass it over to you? They would have to go in there, study the methodology. It was very, very messy.
Right.
So that all changed in 1981 when LIBOR, London Interbank Offered Rate, was adopted in the space for the U.S. dollar market, and it effectively converged all U.S. dollar fixed income products to use this benchmark rate. It just by having that new standard, it changed the game. Like from then on, fixed income just saw a hockey puck in terms of volumes. It just grew exponentially. Like interest rate swaps were developed the year after, mortgage-backed securities were developed a few years later. It was just a huge bump, and just by having a simple standard to say, hey, let's unify a benchmark rate. So as we know, LIBOR turned out to be also a terrible system because it was prone to manipulation, collusion. A lot of banks got fined. So it was very recently replaced with SOFR, another benchmark rate. So coming back to crypto, and how this fits in, Ethereum is a decentralized economy, right? We think that if you want to build a benchmark rate too, you could have centralized authorities that create. It could be like a Binance benchmark. You can have like a Coinbase benchmark. But effectively, we're in a decentralized world. I think it's better to use a decentralized framework to build a benchmark rate. So tying it all together, DOR is effectively taking the principles of LIBOR plus SOFR. We've added in attributes of an oracle. We've also introduced staking and slashing to solve the issues of collusion, manipulation, and then we've added a group of stakeholders. There's 5 of them, and I can go into the details, but I'm sure you have other questions. Yeah.
So, like, why might DOR be used in the crypto space? Like, why is it relevant? It makes sense that this needs to exist, or that we need to have a benchmark. But like, what does this unlock for the crypto space?
Sure, I think when we look at the state of where crypto is, I mentioned earlier, it's like 2.5 trillion, right? The only way for that space to grow is we have inflows effectively, right? Unless you build value internally or there's inflows. And I think the fastest way for that to happen is for institutions to get involved, whether it's tokenization, whether it's RWA. And if you look at the cycle of how institutions have got into cryptos today, or just the history. Well, Bitcoin came out in 2009, and then we had GBTC come out somewhere in 2012. It was the first instance of institutions being able to get access to Bitcoin, and getting an organization to custody it on behalf of them. Obviously, Ethereum came out. We had BitMEX, the perp model that came out. We had Deribit. Then we had DeFi. Now, last year or the past 2 years, we had Bitcoin ETF, ETH ETF. I think the next stage is for institutions to come in, like they've kind of gone through all this skill, and now they have CME, they have derivatives. I think the next step is that now that they can hold Bitcoin and ETH on their balance sheet, they want to have a yield on it and the safest yield possible. Right. They're not going to jump into like the tail end immediately. They're not going to go degenerate. They're not going to jump in there. They have so much money. It doesn't make sense. It'll just kind of distort. They're not comfortable. So the next stage after that, I think, is as simple as proof of stake. Just now holding ETH ETF, there should be a proof of stake ETF. You're earning like the inherent risk-free yield for Ethereum, and then from then on, I think they're gonna question themselves and say, hey, the way proof of stake is paying me out is a variable rate. Can I get into a fixed rate? And locking in your return for like 1 month, that's every institution wants that, right? Because they don't want to have uncertainty on their balance sheet. They want to know that this is the yield I'm going to receive in like 1 month. And I think in order for them to do that, you're going to need to get into an interest rate swap. You either get into a forward. And when those instruments come into play, you're going to need a benchmark rate. So that's the infrastructure that we're trying to build.
Okay. And why can't I use a traditional finance benchmark rate, right? It still exists. Just theoretically, the market is efficient to some degree. Why do we need a different crypto native benchmark?
Sure. You could do that, right? It's ultimately building a standard, but as we learn through centralized benchmarks through history, there tends to be a lot of manipulation, collusion, and you really have to trust that particular source that is doing that data. So whether it's the central bank, they have their own agenda in mind, or whether it's the banks that are administering it. In the case of LIBOR, the banks were lying about their rate so that they could trade on it, right? So they can make P&L on it. So our goal is to build it's a whole new primitive, essentially. Right. Building DOR, or decentralized benchmark rates, never existed before in the model that we created. And effectively what we've done is allowed, distributed the calculation of building a benchmark rate and putting in incentive structure, putting in disincentives as well, right? Slashing if someone's lying, perhaps. So we're trying to build it for a decentralized world.
And it's kind of similar or analogous to kind of how we think of oracles.
Yes, very similar, but there are also key distinctions, right? On an oracle, majority of the use cases right now are related to, like current spot price. With DOR, there's a lot of, it's very much catered for rates, fixed income. There's a curve construction. Effectively, we're building a yield curve, which oracles currently in this state,
right.
They don't have that. There's a lot more technical pieces that wouldn't suit. So funny story is that we actually talked to Chainlink about this. We talked to Band about this, and we wanted to work with them at the start to build a decentralized benchmark rate. But I think for them, even for them, they said, "Hey, why don't you just do it yourself? It's going to require massive change in our structure."
Right, because it's not just a number; it's like a whole entire model.
It's a curve, like it's an interest rate model, and whereas the current Oracle standard, it's very simple. It's just spot. Yeah.
And does the value, where is the value created in this process of creating the DOR and kind of protocolizing, enshrining the DOR, and how does it interplay with your other products?
Yeah, sure. So I think there's multiple ways of how it helps. It's not only us, but DeFi in general. The first is that it creates a standard for people to value risks in general. That's just a basic requirement of a mature financial market.
Right.
The second thing is that by building this benchmark rate, we can now encourage new primitives to exist in crypto. So with Door now live, we've gone live about a month and a half already. We're working with a bunch of different protocols to build new types of borrowing lending models, new types of derivative instruments. We have a protocol that is building using EIP 6123 to create interest rate swaps to settle it on chain. Right, that's one use case. We're talking to not only on chain, even off chain. We're talking to very large market makers and DeFi hedge funds that want to hedge their Ethereum staking rate exposure. They want to get into like a fixed rate, and it's not public yet, but I can share a little bit that it's a project that we've been working for a while. We're on track to hit like 1 billion in trading volumes.
Wow.
On the benchmark that we have, and that's just from institutions wanting to properly hedge, right? So these types of instruments didn't really exist beforehand, and having a clear structure to build a benchmark around it really allows people to experiment, to do new things.
And is there actually value captured at that benchmark? Like, are you in the way that people pay for an Oracle feed, are they paying the protocol?
Yeah, so there's a few ways of how that the economy works within Door. So there's 5 specific stakeholders that I mentioned. I can briefly walk through each of them. The first role is an operator. So we're similar. The analogies were similar to Eigen in that Eigen allows other AVS to build. For us, we allow anyone to build a benchmark rate. So being an operator, you set the methodology. You're basically the curator for the benchmark. And from in terms of what you do, you have to stake a certain amount of our token to be involved. Coming down the list of the other stakeholders, panelists is the second, and effectively they are the data providers that we distribute data across all of them to compute and then come back, so that we don't have to trust one particular source. So right now we're working with pretty much all the largest ETH staking houses like Kiln, RockX, like A41, market makers like Selene, QCP, staking rewards. We have a bunch of great guys that are helping us distribute this data. And for them, they get incentives in the form of our token for providing the service. The third stakeholder is called a referencer. So anyone that queries the feed from the operator, they would have to pay. It's similar to the Chainlink model,
right.
Similar to the PIP model, where you just query and you pay a certain amount of tokens to use it, and that value exchange goes back to between the operator as well as the panelists. Very briefly on the last two, we call them delegation. That's when TETH comes into play, where users who hold TETH, who are now earning not only just WSTETH yield, they're earning the arbitrage yield by helping keeping the market efficient. They can also stake their TETH into specific operators as well as panelists to keep it decentralized. And then finally, we call the last group end users. So this could be retail, it could be institutions that don't necessarily know that there's a benchmark underlying the products that they're using. But they're a very important part of the exchange because they're the main users.
Right. So talk to me how TETH is like a logical next step to build on this product.
Yeah. So the end goal of TETH really is not to earn a ton of yield, right? It's a simple LST, but the key feature and the key, our vision for TETH is that it is a methodology to keep the market efficient, right? Again, there's so much fragmentation from rates, from prices, and it's an arbitrage strategy to help ensure that, if we want to build benchmark rates, it can't be that on the spot time frame, like today, right now, I am able to do, I can borrow from different places in drastically different prices. So we want to make it, TETH is very important to keeping the entire system in check.
Right. How, you mentioned that once LIBOR came out in the 80s, in the early 80s, that there was kind of this like Cambrian boom in the market, or in this sector of the market. Do you think that this could happen to DeFi with the launch of Door?
For sure. Yeah. We're already seeing that, right? Effectively, we're working with, even risk curators that are, looking to experiment with different interest rate models. talking to a lot of borrowing lending protocols like Compound, effectively to say, hey, there could be ways to make this, how the current setup has been a lot more efficient and is beneficial to both you as well as the user. So those are some of the low-hanging fruits. I already mentioned, the $1 billion in trading volume that we're very soon going to be hitting for Ethereum staking rate forwards. I see, even staking houses being able to hedge, like to do structured products. It's opening a whole new door. No pun intended, a whole new door to fixed income. Yeah,
that's funny. And then how meaningful is this for DeFi? Is this going to be like a sector of DeFi, or is it really going to be, a way for billions or trillions of dollars of assets to onboard, and this value is going to help create value within the system? Or is it just going to be like, oh, I'm an institution and I want to earn a little yield, or I want to hedge out a little risk or something?
It's both, right? From the DeFi angle, I mentioned a few protocols that are using us already. You're going to see, in the next few months, a few launches. So definitely we're working with on-chain protocols to build new products. In terms of not just, from the institutional front, right? I think it's going to be extremely meaningful too, because as we know, as I mentioned, fixed income is 5 times larger than equities in TradFi. I think, when you bring assets on chain, fixed income is naturally going to be the first few assets that they bring on. Institutions look at risk from a spectrum. Like, they don't jump to the most degenerate thing first. They go through different stages, and they always, fixed income is their bread and butter.
Right.
Yeah.
So you mentioned previously this idea of like either value created internally or inflows, and you think that this could perhaps be like the missing piece to bring those institutional in. Yeah,
for sure. You just talk about money market funds in the U.S. market. That's a $7 trillion market, right? Wow. And that's just like T-bills that are like 3 months long, right? Not talking about any kind of other instruments that exist out there. It can massively grow the space, right? I think fixed income's the next big theme in crypto.
So we're talking about amounts of capital that are so significant that even capturing a small, a couple bips or something could be incredibly significant from like a cash flow perspective.
It'll be bigger than the entire DeFi market, like just capturing like 2 bips of the TradFi market and just bringing such things on chain.
Wow.
Yeah.
That's very cool. So talk to me about TETH. Like, you guys could have taken the perspective that you wanted to just like create another LST, right? There's probably dozens of LST protocols out there. However, you added this additional component of trying to earn more yield. Why did you approach it from that perspective?
Sure. Yeah. So the underlying LST we're using, we're doing this in partnership with Lido. So when ETH goes into our smart contract, it immediately gets converted to WST ETH, and Lido's obviously the leader. They have great infrastructure. I think there's a lot of trust in them, so we picked them as our partner. And then in terms of the additional yield, so it's a funny topic, because the yield that we're giving users, this arbitrage yield, goes away as we hit our goals, and our goal is to help make the market efficient. So if the market is efficient, technically that yield goes to 0. So while right now users can make anywhere to like 50 to 80 bips, so 0.5 to 0.8% on top of WST ETH. Our goal is actually to make that 0, because when we hit 0, we win. That's the goal. Now we can focus on Door. We can build all these instruments. The market's efficient, right? So it's a funny thing. Like, right now we're giving yield, people are happy, but if it goes away, we're happy too. Right. So yeah.
So then, like, not only is TETH complementary to Door, but at the end of the day, Door is complementary to TETH in that the way that your kind of vision for the future, it needs TETH to create the market efficiency, and then the products that you envision will be able to be built on top of Door.
That's exactly right. Yeah, they're very much intertwined. It needs one to exist. It needs the other to exist.
Right.
Yeah, we started actually only building Door. And then we realized, okay, that's not going to work until the market's efficient. So why not build? We came up with the concept of T assets thereafter. And it's an easy way also for our followers to get involved. They can stake with us rather than an Oracle is a bit more a bit more B2B, a bit more hands-off, right? I mean, everybody knows what Chainlink is, but not many people actually use the Oracle unless you're like a protocol. So with us, there's two ways to kind of participate. One from a B2C front, which is get involved, stake, earn our points, right? And the other bit is, use our system Door to help power new primitives, new products.
You guys' focus has kind of been TETH. However, you mentioned the demand for institutional yield on other assets, dollars, BTC. Do you guys address this at all?
So we will be moving to other types of T assets. So T asset, we named it as such because there's going to be multiple. Definitely. I mean, there's going to be a few new iterations. Not only in Ethereum world, we're going to be launching on Solana very soon. So you can expect that an announcement in the next few months, hopefully sooner, and a few other blockchains as well.
Well, congratulations. And then you also imagine this kind of like long-term future where other products are being built on top of Door. What's like the range of possibility there and some of the stuff that you're excited about that can be built on top of Door?
Yeah, so when it comes to the fixed income world, the most basic instrument that people start with is trading forwards. So forward on interest rate. So with Ethereum staking rate being, the natural risk-free return for Ethereum, forwards market would be the first, allowing people to essentially lock in that rate for a specific amount of time. I think from then on, once you have a forward market that is very active, there's a lot of liquidity, you can then move into, effectively a tree of fixed income products. There can be like swaptions, can be range accruals, like structured products. It's endless effectively. I mean, when it comes to TradFi, again, fixed income has way more instruments than any other asset class.
And so kind of any fixed income instrument in TradFi can have this kind of on-chain crypto native analog.
Yes, and yes, so both on like native inherent ETH yield or crypto yield, we're focusing on that, as well as bringing existing fixed income products through our Oracle effectively on chain. So there's two fronts that we can tackle it.
Mm-hmm. And then do you imagine that like this will be, you guys will have this kind of ecosystem maybe analogous to like Chainlink or an L1 where people are building products on top of Door? Or are they going to be Treehouse native products that you kind of want to be the center of gravity in this industry?
So it's I mean, we would love to do everything, but it's really tough to be good at everything. So, we want to be a layer, right? We want to be effectively just a foundation to help spur the development of new products. Our goal is we're also giving out grants to protocols that are building on top of us. We'll support them. We also have an eco fund that will be coming out soon. So our goal is to not only, we will do it ourselves too, if needed, but if there's someone out there building something cool in fixed income, we'll love to support. We'll give grants as well.
Mm-hmm. Yeah. Phenomenal. Obviously, with the launch of any kind of new DeFi primitive, there have typically been growing pains in terms of like security, right, and the risk that people talk about here. What do you guys do to mitigate risk? Sure.
Maybe I can talk about TETH side,
sure.
Because that's very it's a lot more tangible in terms of the risks. I would subsegment it into three buckets when you interact with TETH. The first of which is smart contract risk. So anytime you get on the blockchain, there is a degree of smart contract risk. Any of the protocols that you get involved, there is that risk, right? So that's the first bucket. The second, and in terms of how we mitigate it, to answer your second part, we have done 10 audits already. We're doing more. We're getting audit done pretty much every month. A new audit on the existing code, as well as any new thing that we push. So security is extremely important to us. The second type of risk is counterparty risk. So any form of partnerships that we have that TETH touches, in theory, there is that risk. Well, the risk is pretty slim. We're using Lido as the base.
Right.
I mean, if Lido goes down, it's systemic, right? It's going to be worse than anything else, right? They host 30% of the staking market. So it is systemic enough to say, okay, that is part of the risk of ETH in general. There's also the risk of touching the protocols, like borrowing and lending protocols. So we're only on the top ones, like Aave. There is that risk there in theory. I mean, it still exists. Mm-hmm. And then the final risk, I would say, it's like market risk. So if there's attacks on like DPEX of it's going to be really tough to depeg ETH. But it has happened, right? ETH to other specific assets.
Right.
But yeah, that exists as well.
Interesting. What are some of the most exciting possibilities that you think this brings to DeFi specifically, right? We talk about the TradFi analogs. Does this open up new doors for DeFi itself? DeFi native products?
Yeah. So using a benchmark, and maybe I can talk about just like, the most, let's talk about Aave, right? The current Aave model uses, it uses a K factor that is a hard-coded number to help tweak the model based on how market conditions are, right? By replacing that with a benchmark, for example, it's going to be a lot more efficient, right? You don't need a governance vote to change that number every single time, and it's based on data that is distributed, right? So that's one example that is pretty simple that can help make DeFi a lot more efficient, make borrowing lending. It's just taking out inefficiencies from the current model. Yep.
So you guys, you talk about it in this technical way, but the part that excites me kind of as a DeFi, fan and user is the idea that like this has been the missing link in DeFi, and you guys talk about this in some of your branding, and it makes sense, right? And the idea that like trillions of dollars are going to be able to come on chain, and that there's going to be innovative financial products that are enabled is not a small thing. It's not a small improvement. It's not just a small improvement. It's a small improvement that like you said in reference to LIBOR, like hockey sticks growth, right?
Yeah.
It could be the missing piece that everything else is able to compound of, and that comes from an institutional perspective and a DeFi native perspective, and that's what I find incredibly cool. You guys have been engaging with a lot of institutional partners. What has been what have those conversations look like, and what is the feedback that you guys have gotten?
Yeah, so I'm in New York right now, right? So I'm usually based in Singapore. I take a trip since the past 4 years of being in Treehouse. I do a trip a year to New York, and what I do is meet the same folks that I know. So I'll meet the banks, I'll meet the likes of Goldman. I'll meet the asset managers, the asset issuers, and just the TradFi like fixed income world. You've seen the transition over the years, right? From not caring about it at all or asking more questions at the start to when we had when Luna happened and everything, when the slump happened, everyone a lot of them closed down their digital asset division. Last year was a slight pickup. I think this year, what we've seen is that there's been a very interesting theme and the disconnect in crypto, which is I think on Twitter everyone's saying like retail, there's a lot of fatigue, within builders, but and even on the price action, right, volumes are generally quite low, but from the institutional side, they're more excited than ever. Right, and I think that's part of the reason is due to the new administration, right? Pushing through so many new, they've done so much already, right? Just within the past month, all these institutions, there is a sense of almost competitive nature where they want to get involved. Obviously, regulation is still stopping them, but they're definitely excited. And you see a drastic change in their tone. They're asking the right questions now. They're not just questioning you of the validity of crypto. They're excited, it's initially, if you asked me 2 years ago about fixed income, I'll say it's a 5-year thing. Now it's as soon as like 1 to 2 years.
Wow.
Yeah, I really believe that.
So, do you think that like part of the block for a lot of these institutions was also infrastructure, and we're seeing a new level of maturity in crypto markets with regards to infrastructure products like Door?
Yeah, I think the barrier for them, it was initially regulation, and with the new administration, that's their key concern. Benchmarks for them, that's like a must-have. So with the fact that there are guys that are building it, right, a centralized version of it. What we're building is just they need that no matter what. So this is effectively a one way to help them get onboarded quicker.
Right. What's your broadest goal with this project? Like, your ambition on a 5 to 10 year time frame.
Yeah, I think we want to be coming back to the what we call ourselves, the decentralized fixed income layer. Anything to do with a fixed income product living on chain, whether it's DeFi or whether it's RWA tokenization, we want to be there, right? We want to be facilitating it, and what we also help is that we help decentralize these benchmark rates, which it becomes trustless. And I think that's very much needed in our space. So we want a world where, and I said this earlier, where it's not just DeFi versus TradFi, it's just going to be finance.
So that's the ultimate evolution is this reconverges with finance.
Yeah. What about you? What do you think? Like, what do you see crypto, DeFi versus TradFi being in like 5 years?
That's a good question. I think in 5 years, we're probably still relatively immature in this space. But I think ultimately my vision is that like crypto provides enough of a marginal improvement across all assets where it sounds trite and people say this all the time, but where crypto eats the world, right? Where it's like, it's more efficient to trade on chain than trade in trad markets, whether that's equities, fixed income, or just simple transactions, right? Using, sending a stable coin to Singapore instead of using traditional kind of like wire transfers. But I think crypto does provide that marginal benefit at the end of the day, and I'm excited to see that future.
Exactly.
Awesome. Well, it's been an absolute pleasure having you. I think you are a really interesting entrepreneur, and you see this opportunity and you see it in a very pragmatic way. And entrepreneurs that are thinking in this way, in addressing this mass market in this really kind of like more professional and web and way that caters to Web 2 and TradFi and trad tech incumbents. Those are really powerful, turn into really powerful organizations. So I'm super excited to see the future of Treehouse, and we'll be following closely. Thanks so much for your time.
Thanks for having me.